Imagine you go to buy something. It could be anything you're spending money for, say a mobile phone. What will you do? You will compare the features, see the quality, and make sure it gives you value for the money that you're spending on it. This is very similar to ROCE or Return on Capital Employed. Now, this is a financial statistic that is used to analyze the profitability and capital efficiency of a company. Hello everybody, I am Vaishnavi and welcome to Alice Blue Online. In this video, we're going to learn all about ROCE. ROCE or Return on Capital Employed is a ratio that helps in determining how easily and successfully a company can generate profit from the capital at its disposal. It is also one of the key indicators used by investors, fund managers, stakeholders, etc. to evaluate the company's performance. But what is the significance of ROCE in stock market? Now, ROCE is a long-term profitability ratio. This is because ROCE indicates the effectiveness of asset performance. Therefore, it can be useful in evaluating the longevity of the said company. Now, in order to operate for long, the ROCE of the company should be higher than the cost of capital. It is important to note that many investors prefer ROCE over return on equity, as return on equity only analyzes the profitability related to shareholders' equity. ROCE takes into account equity and debt, which are key factors for analyzing a company's financial performance. Now let us find out how ROCE is calculated. ROCE is equal to EBIT divided by capital employed, where EBIT is earning before interest and tax. Capital employed is total assets minus current liabilities. So now what is EBIT? EBIT is earnings before interest and tax. EBIT is derived by deducting the cost of goods and operating expenses from total revenue. EBIT is also known as operating income. It shows how much profit a company generates from its operations. Now let's see what is capital employed. It is calculated by deducting current liability from total assets plus working capital. That was the formula to calculate ROCE. Now let us understand this with the help of an example. Assume a company has net operating earnings of Rs 20 lakhs. Total earnings declared by the company are worth Rs 1.8 crores and current liabilities are Rs 8 lakhs. So ROCE, that is EBIT divided by capital employed, will be 20 lakhs divided by 1.8 crores minus 8 lakhs. This gives us a value of 11.62%. That is the ROCE of that company. So now the question arises that how is ROCE different from ROE? Let's see the differences between return on capital employed and return on equity. The first difference is that return on equity assesses how efficiently the equities are managed by the company, whereas ROCE assesses how efficiently the employed capital is being used. The second difference is that return on equity ratio is from the investor's point of view, as it focuses on equity. ROCE ratio, on the other hand, is from the company's point of view, as it focuses on the total capital employed. The third difference is that ROE uses net profit calculation, whereas ROCE uses EBIT for calculation. ROE interprets profitability for equity shareholders, whereas ROCE interprets profitability for all stakeholders. Now let's see how ROCE is used while investing. It is used by investors and fund managers to apply the ROCE ratio to compare firms within the same sector. This helps them to decipher which company is using its money most effectively to generate healthy returns. Now this can help them make informed decisions about investing. A higher ROCE ratio is considered good because the company generates more profits on every single rupee of capital invested. But it can also mean higher cash in hand, as it is a part of total assets. From an investing perspective, ROCE can be very helpful for measuring the financial efficiency of a company because ROCE calculates profitability after deducting the amount of capital required. Well, that was everything regarding ROCE. I hope that it has given you a brief idea about return on capital employed. Thank you for watching. For more such informative videos, make sure to subscribe to Alice Blue Online. This is Vaishnavi signing off. I will see you in the next video.
Investment in securities markets are subject to market risks. Read all the related documents carefully before investing.